So we'll start with budgeting in this class. Now, see, budget is nothing but an estimated performance that you do in the coming days in terms of currency as well as in terms of quantity, in terms of currency and in terms of quantity to be achieved in given time. Is that okay? Estimated performances. What is called budget center? It is a section of organization. It's meant for preparing and controlling the budgets. What could be the expected quantity to be purchased and produced and sold in the coming days? All these things are planned in budget center. So what you supposed to produce or sell will be called the budget, and planning those things will happening in the budget center department. Budgetary control, that what we study here, is nothing but what we predicted, what actually did. If there is any deviation, you have to control it. Okay. Guiding and regulating activities to attaining predetermined objectives. Then you have to go for the budget manual. Manual is guidelines. So if you purchase the mobile, there's a manual. Similarly, budget manual, it's a guidelines to prepare the budget and all. A written booklet for procedure of budgeting. Budget period, for how long you supposed to purchase this quantity, for what could be the period? It's for the 3 months or 1 year or 5 years or 10 years. If it is for anywhere between 1 month to 3 months, it may be short term. Anywhere between 6 months to 2 years and 3 years, then that is called mid-term, and more than 5 years or 10 years, then it will be long-term. Like. Clear? Now in budget, okay, you have to understand principal budget factor. This principal budget factor is similar to the limiting factor. That is scarce resource you studied in marginal costing. Okay, so you have your capacity to produce 1000 units. This is the capacity of your production. And market demand being 800 units. Come on, tell me. Tell me. Labor force available for producing 1200 units. Raw material is available for producing 900 units. Come on, tell me. What is the number of units you're supposed to produce for all the calculations? 800. So if you plan to go for 1000 units produced as your capacity being 1000, you cannot sell them in the market. So the 200 units produced excess remains unsold, maybe a loss of your revenue. And labor force also, it's better to reduce to 800 units extent so that you no need to pay the money for idle time. And raw material procure only to the extent of this one. Suppose market demand is 1800, then your raw material available to produce only 900 units. No, your entire production plant will be based on the 900 units. Similar to the limiting factor you studied marginal costing. Say here is here also a number of factors are there. The principal factor remains scarce for us is the deciding factor. Based on that, we will plan all. What we plan? If we decided that market demand is only 800, so we plan that we have to produce 800 units. That's the starting point. Based on that, what is the cash requirement? What is the raw material requirement? What is the labor requirement? What about the overhead we are supposed to spend? And what about the marketing expenses we plan to sell? All these things are then planned. prepared. So we start prepare the budget for various requirements, maybe in terms of quantity, in terms of rupees. Is that okay? And each and every budget for raw material procurement, consumption, labor, and all, called a functional budget. If you collectively prepare all these things put together, then it's called master budget. Hope you'll be now able to understand the concept master budget. Master budget is a consolidated summary of various functional budget. So what is called functional budget? Purchase budget, sales budget, production budget, planned utilization budget. So all these things are again functional operation, right? So how many units is supposed to produce is called functional budget. All these things comprised will be called as master budget. Then other thing can be guessed based on the name itself. Cost budget, the amount you spend for producing any item. Profit budget, the profit you expected based on the number of units sell and what's the profit you will earn for every level of production. Financial budget related to cash budget, not only that capital expenditure budget. You have to understand the difference between cash budget and financial budget. Cash budget is nothing but the inflow and outflow of cash. Financial budget is nothing but not only amount you spend and receive for this, and you think about your capital expenditure also. So all these things will be studied here, budgeted balance sheet and everything. Physical budget is related to the physical unit of sales and productions without the rupee. How many units is supposed to produce, how many units is supposed to sell, and what is the raw materials quantity in kg or liter you need to purchase. Not in terms of rupees, it's called physical budget. And of course, based on period, short term, long term, and medium term will be there. And basic budget. Basic budget is a static or unaltered budget over a long period. Okay, static budget or unaltered for a longer period. Hope you'll be now able to understand this one. What is called static and unaltered? Static and unaltered. So basic budget is a static budget, remains unaltered for a longer period. Is that clear? That's called basic budget. Okay. So whatever the things you repeatedly doing, will be falling under the basic budget. Something special you have to plan. Every day you are coming to the classes and you know what is the amount you need to keep for transport, and if there is any extra need, you have some safer money. Suddenly you plan to go for a tour, then immediately your regular plan gets changed. Then you verify with your cash balance and what could be the estimated amount you require for the to and fro and spending in the tour duration. So that will be for the specific thing for the tour plan. Is that okay? Tour plan. The regular day-to-day activities are now standardized, and you will have a constant checklist. You just follow that. Okay. So remains unaltered over a long period time. What we do in Singar Academy, we will fix the classes in the evening every day, and Sundays and weekends and holidays we'll have a full day class. That's a static. Okay. Suddenly what happens now, if we have a 2 day seminar and 3 days special lectures, then immediately we'll plan and intimate you ahead and promote, and all these things we'll do now. That will be tentative budgets. Hope you'll be now understand. That is called current budget. Used for a shorter period. Only for the 3 days or 4 days only we plan this. This is called current budget. So basic budget and current budget. And you have to understand fixed budget as well as flexible budget. For your examination, most of the cases you will end up with the flexible budget. Rarely you will come across with cash budget, and most important being this functional budget. So first choice, second choice, and third choice for your examination. So very often in every 3 or 4 attempts, once flexible budget will be there. One of the easiest ones, if you are able to understand the marginal costing, this topic is very simple. And of course, this second chapter, second content, functional budget, you have to think. Most of the students will think, is there any format for functional budget? Means definitely there is no any format. Okay. So planning for the constraints given in a better manner and present in a suitable manner. That's all. That's all about the functional budget. Most probably, I'll just give a small format, but not necessarily within the same format. It may be different also, right? So because of the reason, only students would get confused with respect to the functional budget. And in case of financial budget, predominantly we'll study cash budget. Okay. Fixed budget. What is called fixed budget? Budget designed to remain unchanged irrespective of the level of the activity. Otherwise, unchanged one. If I ask you to produce 500 units, what about the revenue? What about the cost? What is the result? Profit or loss? You have to state this for 5,000 units. Clear? This is called fixed budget. Sales cost for 5,000 units. Profit because of selling 5,000 units and all. Immediately MD gets doubt. Okay, 5,000, okay. If it is being 6,000 units, if it is being 8,000 units, can you give me the results? What could be the sales and what could be the cost and what could be the profit and all for this level, this level, this level? Yeah, of course, then you can answer. If I answer you the profit earned for 5,000 units, then it's called fixed budget. If I prepare for this, then it's called fixed budget. If I prepare for this, then it's called fixed budget. But if I'm presenting all the details for the ready reckoner like, then it's called flexible budget. So flexible budget is nothing but a series of fixed budget. A series of fixed budget. In this case, the main thing that you have to understand is classification of the cost. Maybe pure variable cost and semi-variable cost and probably sometimes fixed cost. Fixed cost remains constant at all the three levels and variable cost proportionately varying, semi-variable not proportionately varying. So, varying but not proportionately, you have to segregate into variable as well as fixed, and variable will be treated as this one and fixed will be treated as this one. Is that clear? Hope now you'll be able to understand. Usually for the budget, we'll keep the previous year's track record as a base to determine what could be my requirement in the coming days, right? So previous year's details will be the base. Suppose this is the first year. We don't have the previous year. How can we prepare the budget then? So keep the base 0. That's why it is called zero base budget. So zero base budget is nothing but where the base is 0. Last 3 years, the profit being 10, 12 and 14. Then if you ask you what could be your profit in the next year, as the profit shows a trend, next year maybe 14 to 16. That's how we can guess. Okay, then it is called normal, predicting the future, forecasting and planning ahead of that. So forecasting is the first step. Planning for the forecasted things to be performed will be the second one. The second one is the budget. So forecasting falls the first one. Second will be reactions for that. The reaction is called budget. Clear? Now, if I don't have anything in the previous year, this is the first year I supposed to start. How can I predict what could be my sales in the next year? Or the sales in the previous year being 10, 12 and 14, there's a major change in your operations as well as you introduce major renowned new innovated machine. Because of the changing the operations and introductions of a totally different machine, the result will not reflect the previous year's information. Then what we can do? That time also you remove the previous year's data as a base, then also zero base. So zero base is a method of budgeting whereby all activities are re-evaluated. Like earlier will be totally removed. Each time a budget is formulated. Usually assume that base is 0. Every year I assume the base is 0. Re-evaluate afresh, then it's called zero based budgeting. Clear? Hope you'll be now able to understand. Let's start with the flexible budget. It's very easy, just similar to the concept what you have learned in marginal costing. I'm going to solve this here. I'll finish up. So first one is all about material procurement and labor budget, and second one is all about production budget, and third one we'll start with flexible budget. So we'll try to finish a flexible budget and cash budget, and then we'll go for the production budget and all. Clear? Come on. Solve this illustration along with me. A factory is currently working at 50% of its working capacity and produces 10,000 units. So current production capacity be 50%. 50%. What is the number of units produced now? 10,000 units only. At 60% working capacity, the raw material cost increases by 2%. So raw material cost increases by 2%, and selling price falls by 2%. At 80% capacity, at 80% capacity, okay, raw material increases by 2%, selling price decreases by 2% at 60% capacity. At 80% capacity, raw material increases by 5% and selling price falls by 5%. Right, at 50% working capacity. The product cost us 180 per unit and sold 200 per unit currently. Okay, the cost of 180 is made up as follows. Let's start with. Now tell me. Now tell me. For 50%, 10,000 means for 60% is what could be the number of units you can plan to sell? Come on. So you can do the cross multiplication. It is 12,000 units. And here 16,000 units. And we have been given the per unit details here. Currently, sales being 200 rupees per unit. Right. Apart from that, total cost. In total cost, we have material, labor, factory overheads 30 rupees, and 40% fixed. Okay, fixed as well as variable. Fixed part 40% means 12 rupees per unit, 18 rupees is variable. So factory overhead, variable nature, 18 rupees per unit, and administration overhead, variable being 50% fixed and 50% variable. Is that okay? 10 rupees. Okay. Similarly, fixed overhead, admin overhead, fixed nature. Material cost being 100, labor cost being 30, factory overhead variable being 18, admin overhead variable being 10, factory overhead fixed being 12, admin overhead fixed being 10. Then for 10,000 units, 20 lakhs, am I right? Material being 10 lakhs and labor being 3 lakhs. Factory overhead being 1 lakh 80 variable nature, admin overhead 1 lakh variable nature, and factory overhead fixed 1 lakh 20,000 rupees, and 10 into 1 lakh 10,000 1 lakh. Okay. Now total cost being 180 per unit, 18 lakhs for 10,000 units. Then your profit being 20 per unit, 2 lakhs in total. So when you move for 60% level of operation, the per unit cost, sales value decreases by 2%, 2%, 4 rupees will go down. So 196 will be your revised sales price. Material price increases by 2%. Material price increases by 2%. 100 becomes 102 hereafter. Labor no change. Variable fixed overhead variable no change. Admin overhead variable no change. But in case of fixed overhead related to the factory and admin will not be calculated per unit basis. That value will be common like the earlier one, 1 lakh 20 and 1 lakh. It will not change due to the change in the value. Is that clear? So 196 into 12,000. What's the value? 22 lakhs. 23 lakhs 52,000. And balance 102 into 12,000, 12 lakhs 24,000. 13 to 12,000, 3 lakh 60, 2 lakh 16, and 1 lakh 20. Okay, that's all. Now the total value being 21 lakhs 40,000. If you subtract this value, the ultimate value being 2 lakhs 12,000. Clear? Actually, last exam I think they asked to mention the variable cost separately and fixed cost separately and then profit list separately. Then you have to, in your case, I could remember. Okay. Okay. She did the answer correctly, but almost 50% mark reduced. 20. 7 marks question, she got 3 marks. 7 marks question, she got only 3 marks because in the question they have clearly stated what is the total variable cost, what is the total fixed cost, what is the total cost. She did everything like the way I have solved here. So read the question, what they ask should be there in the question, in your answer. So here nothing stated, so never bother about that. Okay. Yeah, nowhere I have included such an illustration. Last year or last year or which year question? December 2024. Okay, December 2024 question. If you are able to see that, suggestions, go and see. Sum is very simple. 7 marks, nothing is there. But the trouble, they asked to show the variable cost separately in total and total cost also, means variable cost plus fixed cost both. Okay. So for 3 years, no. For every 1 year, 1 mark is reduced, 4 marks is done. 6 marks is, that's how they could reduce. Be careful. Now, 5% decrease in sales price, then it is now 190. Material cost increases by 5%, so 105. 105. Labor remains same, fixed overhead remains same per unit, and this is also remains same. But when it is all about total fixed cost, per unit may be changing, so total remains the same. 1 lakh 20 and 1 lakh remains the same. So 190 into 16,000, this value being 16 lakhs 80,000 rupees. 16 lakhs 80,000 rupees. And your sales revenue being 190 into 16,000, 30 lakhs 40,000 rupees. Similarly, for labor, 30 into 16, 4 lakhs 80,000. And here, 2 lakhs 88,000, 10 into 16, 1 lakh 60,000 rupees. Total cost here being 28 lakhs 28,000. And your profit, the difference between sales and total cost, 2 lakhs 12,000 rupees. At 60% capacity itself, you make nice profit of rupees 2 lakhs 12,000 rupees. Is that clear? Shall I move on to the next one? Come on, make it faster. Unit calculation is not required. If you want, then you can do it. Unit calculation that you can do it yourself. No problem. Read the question. Read the question always. Whatever the things asked in the question, you have to be careful to check whether the question is answered properly as per the requirement. If it is clear, text me. Now, the next question, the same question I think. Showing distinctly marginal cost and total cost. What is called marginal cost? Variable cost. So you have to show variable cost separately and then add fixed cost and show the total cost. If you don't show this, then you will lose the mark. Right. The following information is obtained from the records of manufacturing company for a budgeted production of 10,000 units. And you are required to prepare the budget for the production levels of 6,000, 7,000, 8,000 respectively. So we have to prepare for this 6,000, 7,000, 8,000. Now, direct material variable cost, direct labor variable cost, variable overheads, fixed overheads. This is variable expenses, selling expenses. Segregate that. Variable component being 90%, 27 rupees per unit. 3 rupees is the fixed component. Administration expenses, 1 lakh rigid for all levels. For 10,000 units, 1 lakh means per unit being 10. So, fully fixed. That expenses, 20% being fixed. 2 rupees is fixed and 8 rupees is the variable cost. Sales price is 320. Sales price being 320. So you are required to prepare a budget for production levels of 6,000, 7,000 and 8,000 units respectively, showing distinctly marginal cost and total cost. So just pick the marginal cost first of all. Right. What are they? Direct material per unit, 120 rupees, direct labor 60 rupees, variable overheads 50 rupees and variable expenses 10 rupees and this one selling expenses being variable nature 27 rupees and distribution expenses 8 rupees. This will be the marginal cost. What is the marginal cost? $275. Now I name this being marginal cost. Fixed cost. In case of fixed cost, we have been given fixed overhead and selling expenses, admin expenses and distribution expenses. These things are constant, 3 lakhs constant for all the levels. Is that okay? I can finish up that later on to get the presentation better. 120 into 6,000, 7 lakhs 20,000. Here 3 lakhs 60. and 50 into 6,000, 3 lakhs. Here 60,000, 1,62,000, 48,000. Total 16 lakhs 50,000 rupees. For 7,000 units, 8 lakhs 40. 60 into this one, 4 lakhs 20, half of that. 10, 70,000 rupees. See, this is how you can calculate. You can multiply with 10 easily. 5 times of this, 3 lakhs 50. Okay, 27, 1 lakh 80, 9,000 rupees. And 14,000 should be subtracted from here, 56,000. That's how you can calculate mentally without using the calculators also. The total value in this case being 19 lakhs 25,000. For 8,000, 9 lakhs 60, 4 lakhs 80,000, 4 lakhs 80,000 rupees, 2 lakhs 16,000, 64,000. Overall total being 22 lakhs. And in case of fixed cost, at all level, this remains same, 3 lakhs fixed overhead. That remains the same. Selling expenses being 3 rupees per unit for 10,000 units. Whenever fixed overhead is given per unit basis, it is applicable only for the given level of operation. 3 into 10,000, 30,000, that remains constant at all level. If the given level of operation is only 5,000 units, 5,000 into 3 should be taken. Okay. Admin expenses 1 lakh rigid, all the levels, at all levels, so constant at all levels. And distribution expenses 2 rupees per unit for 20,000, 10,000 units, 20,000 rupees. I think similar question was asked in the exam 2024. Am I right? Similar question. So marginal costing separately, total cost separately. So total fixed cost 4 lakhs 50. 4 lakhs 50. It remains constant at all level. And find out the total cost. 21 lakhs, 23 lakhs 75,000, 26 lakhs 50,000. Now find out the cost per unit. Cost per unit 350, 339.28, 350, 331.23. Total cost divided by units of production. Okay, hope the unit of production is here, total cost is here. Divide the total total cost. Okay, this one is total cost. Total cost is divided by the units, you will get the cost per unit. Shall we move on to the next one? Question number 5. Shall I move on to that? Come on, make it faster. Online students, text me. Now, the cost of a product at a capacity level of 5,000 units is given A below. This is for 5,000 units. For a variation in capacity above or below this level, the individual expenses vary as indicated by below. So, material cost, labor, and stores depreciations are, so these three are 100% vary. Find out the unit cost of the product under each individual expenses at budgeted production level of 4,000 units and 6,000. So you have to calculate for 4,000 as well as 6,000. Okay. Find out the unit cost also. Finally, you have to get the unit cost of product also. Finally, whatever the things asked in the questions, you have to monitor it properly and answer it. So for 4,000 units, for 6,000 units. Right. We'll start with the variable cost. Total variable cost. Material cost. For 5,000, 2.5 lakhs means how much is per unit? How much is for per unit? 50 rupees. And labor cost 30. Stores 2 rupees. In case of power, 20% being fixed, 2,500. Variable 10,000. 10,000 for 5,000 units means 2 rupees. Repairs 15,000 being variable, 5,000 being fixed. I have to take the variable first. Repairs and maintenance 3 rupees. Inspection variable 20%, 1,000. Fixed 4,000. Finish of variable first of all. Inspection 1,000 for 5,000 units means 0.2. And administration 25%, 12,500 is variable, 37,500 fixed. Finish of variable first of all, admin 12,500 for 5,000 means 2.5. Selling expenses 15,000 variable, Another 15,000 being fixed. Okay, selling expenses. 15,000 for 5,000 units, per unit being 3 rupees. Now go for the fixed cost. Fixed cost. Under that, first one being power. I'll finish up this first of all, material cost and all. 50 into 4,000 units, 2 lakhs. 30 into 4,000, 1 lakh 20. 2 into 4,000, 8,000. 2,000 into 4,000, 8,000. 12,000. 800. 10,000. This is 12,000. What is the value for the stores? 8,000. Okay. Okay. Get me the total of variable cost. Three lakhs 70,800. And for 6,000 units, for 6,000 units, 3 lakhs, 1 lakh 80,000, 12,000, 12,000, 18,000, 1,200, 15,000, 18,000. Get me the total then. 5,56,200. Am I right? In case of fixed, we will start with the power. Power being 2,500. Are you getting this value? 5,56,000. Okay. This will be 2,500 for both the level of operations. And repairs, 5,000 for the both the level of operation. Irrespective of the units produced, this cost you have to incur. And inspection, 4,000. And depreciation is always 100%. Static, okay, fixed. And in selling, 37,500 is fixed. 37,500 is fixed. And okay, this one is admin. Now selling expenses. Selling expenses 15 is fixed. Get me the total fixed overhead. One lakh 64,000. It remains constant at both the level of operations. 1,64,000. Now, if you add up these two, your total cost in this case being 5,34,800, 7,20,200, and cost per unit in this case being 133.70, 120.03. Hope now you'll be able to understand this one. 4,000 units, total cost is this much. So you divide the total cost by number of units produced to get the cost per unit. 5,34,800 divided by 4,000. 7,20,200 divided by 6,000. Now, we'll move on to the next illustration. This illustration is one of the unique methods because you have been given the total cost for the different level of operation for production of 1,20,000 units and 1,50,000 units. Cost is given. You need to prepare a budget of total cost 1,40,000 units. So then you have to find out the variable cost as well as fixed cost and semi-variable and all. If the cost being semi-variable, now it's your duty to segregate the semi-variable into fixed and variable, and then you can proceed further. One of the beautiful illustration, that's why I have incorporated here. Finance manager of J Electrical Limited is preparing flexible budget for the accounting year commencing on 1st April 2011. The company produces component K of a product, direct material cost being 7 rupees per unit. Direct labor averages 2 rupees 50 paise per hour and requires 1.6 hours to produce 1 unit of component. So you have to find out the direct material. You have to find out the direct material. For how many units is supposed to produce? Calculate. 1,40,000 units. Okay, direct material cost being 7 rupees per unit call. For 1,40,000 units, what could be the value? 9,80,000. There is no doubt here. In case of direct labor, 2 rupees 50 paise required per hour. For producing 1 unit, we need 1.6 hours. So 1.6 into 2.5, the direct labor hour, the cost required for 1 unit being 4 rupees. Am I right? 2.5 into 1.6. Okay, 4 rupees. So for producing 1 unit, we need 1.6 hours. 1 hour costs us 2 rupees 50 paise, means 2 rupees 50 paise into 1.6, you will get 4 rupees for producing 1 unit. 4 into 1,40,000, 5,60,000 rupees. Okay, salesmen are paid a commission of rupees 1 per unit sold. Sales commission, 1 rupee per unit sold. So we assume the production is equal to the sales, no stock. So 1,40,000 units sold, then 1,40,000 rupees. Fixed and selling and administration expenses amounting to rupees 85,000 per year. Okay. In case of fixed cost, under that admin cost, fixed cost under the admin cost. Fixed, these are variable cost, fixed cost, under that admin. the value being 85,000 per year. Manufacturing overheads. This is the unique requirement for this illustration. Manufacturing overheads has been estimated in the following amount under specified conditions of volume. 1,20,000 units and 1,50,000 units are there. If you find the cost being equal in both the level, then it will be purely fixed cost. Is that okay? So here we have the depreciation being 90 remains constant. Am I right? Fixed cost remains constant all the level. Engineering 94,000 constant at all level. And rest of the 1, 2, 3, 4, 5, 6, 5 items total. This total is split this way. Among the 7 expenses, 2 expenses are purely fixed. And what about the rest, sir? We are not sure whether it's fixed or variable. Maybe variable. In case of variable, will it be a pure variable or not? I am not sure. Now, I had to find out the per unit value for 1,20,000. Come on. 2,64,000 for 1,20,000 unit means per unit cost is 2.2. And 1,50,000 divided by 1.2, 1.25. 90 by this one, 0.75. Am I right? 90 by 1,20,000. 84 divided by 1,20,000, 0.7. 198 divided by 1,20,000, 1.65. Find out the per unit for 50,000 units. 330 divided by 150, 2.2. And 187,500 divided by 1,50,000, 1.25. And 112,500 divided by 1,50,000, 0.75. And 1,02,000 divided by 1,50,000, 0.68. And 2,34,000 divided by 1,50,000, 1.56. So you know that in case of variable cost, these two should be same. If the cost per unit remains constant for different levels of operation, this will be pure variable cost. But in this case, maintenance and supervision in total also not same, per unit also not same, then these two are semi-variable. Semi-variable is nothing but some of the portion may be fixed, some of the portion may be variable. Let's finish up the available information first of all. So I have completed this one, and pure variable cost is going to be posted here. Indirect material, IM. This value being 2.2. If the indirect material 2.2, then total value being 3,08,000. And indirect labor 1.25 per unit for 1,40,000. Indirect labor being 1,75,000. And inspection per unit being 0.75, that remains constant per unit basis. 1,05,000. I have posted all the 3 items. Now when it's all about maintenance and supervision, these are semi-variable, means some portion may be variable, some portion may be fixed. So your duty to segregate that. In case of maintenance, in case of semi-variable, variable cost can be identified this way from semi-variable, variable cost. You can find out the variable cost is equal to difference in total cost divided by difference in units. That's how you will get the variable cost. Very simple. You know that total cost comprises total variable cost and total fixed cost. From that formula, you can get the fixed cost also. Okay, C. Total cost is equal to total variable cost plus total fixed cost. Total variable cost, you know, quantity produced into variable cost per unit. So total cost is equal to quantity produced and sold multiplied by variable cost per unit plus total fixed cost. These are the two normal formula that you understand logically used here to segregate the semi-variable cost into variable cost per unit as well as total cost. Total cost. Is that okay? Now let's try to calculate or break the cost for maintenance. Maintenance. Total change in total cost being 102 minus 84 in thousands divided by units being 150 minus 120. Come on, get me the variable cost per unit. 0.6. And total cost in this case being 84,000. Total cost, I am applying the second formula, 84,000. This 84,000 total cost is applicable for 1,20,000 units multiplied by variable cost per unit plus fixed cost. Is that okay? I am using the second formula here. I am using the first formula for calculating the variable cost per unit. From this, you can calculate the fixed cost directly. 1,20,000 into 0.6, 72,000. To find out the fixed cost, 72,000 is taken to the other side of the equal, minus then 84,000 minus 72,000, 12,000 is fixed cost. I'll post that value here. Maintenance. Maintenance variable nature being 0.6, maintenance fixed being 12,000 rupees. If the maintenance per unit being 0.6 for 14,000 units, the ultimate value being 84,000. 84,000. Let's now move on to the next one. Supervision. Supervision. In case of supervision, variable cost per unit is equal to difference between the cost 234 minus 198 divided by difference between the units 150 minus 120. It's difference between. Don't say it's negative or positive and all. Okay. What is the ultimate value here? 1.2. So 1.2. Now by applying the second formula, I can get the fixed cost. The total cost for 1,20,000 units in case of supervision is 1,90,000. Sir, can I take the second value, sir? Yes, of course you can take the second value also. If you take the second value, the quantity will be 1,50,000. The variable cost here in this case, total cost being 2,34,000 is equal to 1,50,000 because this 2,34,000 total cost is for 1,50,000 units. So 1,50,000 into applicable variable cost we found out in the earlier formula 1.2 plus fixed cost. Now we can calculate the fixed cost easily. 1,50,000 into 1.2, 1,80,000 along with the fixed cost. To get the fixed cost, that 1,80,000 taken to the other side becomes negative from 2,34,000. The final value being 54,000. So supervision per unit being value being 1.2 and supervision in total 54,000. Per unit being 1.2 means you multiply with 1,40,000, you will get 1,68,000. Get the total fixed cost and total variable cost. Total variable cost being 22 lakhs. You can calculate the total cost. I'll get the total cost directly, 28 lakhs 55,000. Or you can show total variable cost, total semi-variable cost and total fixed cost. Okay. Then you can get the total cost of all the three. That way I solved the question, but it's not clearly asked in the question. So I followed the variable as well as fixed cost version. Now, so with that flexible budget, all the models are over. Okay. Standard costing, marginal costing, and budget. These three chapters carry almost 25 marks to 30 marks. Almost we have covered more than 1/4 syllabus. Standard costing and marginal costing, budget and budgetary control. Okay. So, see inter group 2, I have shown the chapter number 13, 14, 15 carrying this much mark. In CMA inter group 1, it's all about B series, C series, cost accounting techniques. Standard costing, marginal costing, budget and budgetary control will be called as cost accounting techniques. Okay, carries around 30 marks. For the CMA group 2, it may be totally different, I think. Okay, almost 50% mark is over with these three chapters. Now, C. Come on, tell me. How will you calculate the purchase or sales? Purchase or sales. In case of a trader, if you ask you to prepare the purchase budget, opening stock, usually sales budget, opening stock plus purchases minus closing stock is what? Sales. Isn't it? This is sales budget in terms of units. In terms of units. Sir, everybody know. Everybody knows this. Opening stock plus purchases minus closing stock is the sales. Everybody knows this. Is that clear? Now, in case of rupees, what happens? Opening stock appears at cost. All the three appears at cost. Isn't it? Then opening stock plus purchases minus closing stock. Then add GP or profit to find out the sales. This is also purchase budget. For whose angle? For what's angle? Rupee angle. And whose angle? Trader's angle. Trader. What about manufacturer? He will not purchase and sell directly. He purchases the raw material, converts that raw material to finished goods and sells. We'll see that format later on. For him, we have purchase budget, consumption budget, production budget and sales budget. 4 budgets are there. For the trader, purchase budget and sales budget will be there. In case of purchase budget, we either prepare using the units only or we can prepare using rupee. Physical method, right? So we have seen now physical budget. Physical budget where we never bother about the rupee. So here, if I ask you to prepare the sales budget, simple. In case of units, opening plus purchase minus closing stock sales. In case of cost budget, in case of this one, sales budget, this will be called cost of goods sold. With that GP is added. Sometimes you may be asked in another way, what is that? Purchase budget. In case of purchase budget, you prepare the same way, you calculate this as a missing data like. But as a customary practice, what we do know, whatever the budget is supposed to prepare, that requirement will be the last line. See here, sales is the last line. Isn't it? Opening stock plus purchases minus closing stock sales. It means sales budget. In case of purchases budget, what should be the last? Purchases should be last. Then you can rewrite this other way. How? Start with sales. Okay, start with sales. And closing stock should be added. Minus opening stock. Then you will get what? Purchases. What? In terms of units. In terms of units. In terms of rupees, sales From there, you have to first subtract the GP or profit to get the cost of goods sold. Thereafter, add closing stock and subtract opening stock to get what? Purchases. Very simple. Very simple. So, sales budget. In case of purchase budget, in case of purchase budget, so in case of sales budget, opening stock plus purchases minus closing stock, units, the entire value will be your sales. In case of rupees, this will be cost of sales and you have to add the profit to get the sales. But in case of purchase budget, it is posted in a different way. Being the trader, he has to prepare two budgets. One is all about finished goods purchased budget, finished goods sold budget. He will not bother about purchasing the raw material. It's not his duty. He's a trader, buying and selling. What happens in case of manufacturer, sir? In case of manufacturer, four budgets are prepared. One is all about raw material purchase budget. Another one is after purchase, you are not going to sell. What are you going to do? You are going to consume the material. After consumption, you produce this production budget. Later on, you go for sales budget. Sales budget. Raw material purchase budget is equal to the purchase budget, like, right? So, raw material purchase budget. Okay, in case of raw material purchase budget, you have to start with sales, add closing stock minus opening stock, you will get the purchases. You will get the purchases. Is that okay? But in case if you want to add profit, in case of rupees, you have to remove the profit from the sales. Whenever you remove the profit from the sales, is the cost of goods sold. That will be comfortable for calculating purchase budget. This purchase budget, you know, will be similar to the production budget. Either it may be raw material purchase budget or raw finished goods production budget. So in case of production budget, what do you do? Finished goods production budget. What is the sales minus profit, cost of sales, closing stock is added, opening stock is subtracted, then produced. If you are being the trader, you purchase and sell. But if you are a manufacturer, you produce and sell. So purchase budget is equated with the production budget. Clear? Hope you will be now able to understand these two. So raw material purchase budget is similar to finished goods production budget. Then sales budget is equivalent to what? Raw material consumption budget. Sales means I am selling to the outside. Raw material consumption means the purchased raw material is consumed by myself. So raw material consumption budget is similar to finished goods sales budget. In case of sales budget, opening stock plus purchases minus closing stock, you will get the cost of sales and profit is added to get the sales. But you are not going to sell, you are going to consume it yourself. Okay. So in case of sales budget, use opening stock. As you are being the manufacturer, you are not purchasing the finished goods. You are purchasing what? Raw material, and you are producing it. So rather than adding the purchases, you are going to add the production. And closing stock subtracted, cost of sales is you are arrived, then profit is added to get the sales budget here. Is that okay? Either it may be sales budget or raw material consumption budget. Now, in case of labor, you have to understand this one. Okay, performance rating. Performance rating. Performance rating. Time taken, time allowed being 10 hours. Time taken is 10 hours. What does it mean? Your performance rating is equal to 100%. Very simple. Time taken by time allowed. Performance rating can be calculated this way. Time taken divided by time time allowed by time taken in percentage. Is that okay? That's what about the performance rating. Suppose time allowed is 10 hours, but time taken is only 8. What happens here? You are going to be good performer or over performer. Okay. To finish the duty, you have to usually consume 10 hours, but today I completed in 8 hours itself. So you are very fast. So your performance rating is better than the average. So 10 time allowed divided by time taken 8. What's the ultimate value? 125%. You are good at performing the duty. If time allowed is 10, but you have taken around 12 hours, then 12 by 10, sorry, 10 by 10 by 12, 83.33%. Is that okay? Come on, tell me. How will you pay the salary to the employees? Based on the time allowed or time taken? If nothing stated, based on the time taken. Usually based on the time taken. So if it demands the premium or bonus, of course you can pay. Usually based on the time taken, we offer the salary. Okay. So from this, it is very clear. You have to find out the time taken. You have to find out the time taken. See, the question may be given this way. Standard time for a job is 100 hours. Hourly rate being 500 rupees per hour. 500 rupees per hour. Okay. Performance rating being 125%. Find out the wages. So what we need to have, unless to find out the wages or labor cost, you have to find out the time taken into hourly rate. Now the question is, time taken is question mark. How will you calculate the question time taken? So the formula is here, performance rating is equal to time allowed by time taken. To find out the time taken is equal to time allowed by performance rating. So time allowed in this case being 100 hours divided by performance rating being 125%. 8 hours. Then salary being per hour 500 rupees means 500 into 80, 40,000 rupees. Of course, he may be given some other premium if it takes the time beyond the normal working hours. So you may demand the overtime also, overtime premium. You can add those things also here. Time taken into hourly rate plus overtime premium can be added to this. That's how we can find out the labor cost. Especially for the labor cost calculation, you have to understand how to apply the performance rating here. So I have given the format here. Performance rating is equivalent to time allowed by time taken. That very, very important. That point is very, very important. Second, if he is asked to work beyond the office hour, he may demand some extra premium also, overtime for overtime premium. Third, there may be losses due to the idle time. Because of the idle time, we need to offer the payment without any revenue. Even there may be chances of a breakdown and all, and absenteeism. So these things also playing a vital role in determining the labor cost here. Okay. So while preparing the budget for the labor cost, you have to assume all these aspects to calculate perfect. So material cost is pretty simple, but for this you have to work a lot. Clear? With this small briefing, let me go for a comprehensive illustration. Then you will be able to understand much better way. Question number 1. Question number 1. Now, ABC Limited manufactures 2 products using one type of raw material. 2 products, only one type of raw material is used. And one grade of labor. So we have the multi-grade laborers also, right? Skilled, semi-skilled and unskilled and all, right? We have studied in standard costing. Similarly, we may also have different grades of employees. Shown below is an extract from the company's working papers. Okay. Okay. Of the next period's budget. Budgeted sales, budgeted material consumption per product, budgeted material cost, standard hours are allowed per product. Okay. These 2 information is for the material. These 2 information is for labor. Overtime premium 50% and is payable if worker works for more than 40 hours a week. So overtime also be applicable. There are 90 direct workers. The target productivity ratio or efficiency ratio, usually performance rating. For the productive hours worked by the direct workers is actually manufacturing the product is only 80%. In addition, the non-productive downtime budgeted at 20% of the productive hours work. Apart from this, the machine's efficiency itself 80%. If you are working for 100 hours, 80 hours can be worked and another 20 hours may be lost. In that 80, downtime, non-productive downtime also be there. Around 20% of that means another 16 will go off. So 100 hours if you plan, 20 hours will directly go off because of the productivity inefficiency 80. In that you can produce only 80%. Another 20% on this 16% will go off. So only 64 hours may be effectively used for the productive purpose. There are 12 5-day weeks in the budget. 12 5-day weeks. So 12 into 5 day, 60 days. Okay. In the budget period, and is anticipated that sales and productions will occur evenly throughout the whole period. It is anticipated that the stock, so this information related to the labor. It is anticipated that the stock at the beginning of the period will be product A 1020, product B 2400, raw material 4300. The target closing stock expressed in terms of anticipated activity during the budget period are A 15 days sales, B 20 days sales, and raw material B not based on sales, it's only based on the consumption. So this information is for what? Material. Calculate material purchase budget and then the wages budget for the direct workers, showing the quantities values for the next period. So let me finish up the material purchase budget first. From this entire illustration, I just picked the item only for the material calculations. What are they? These are the 3 lines. These are the 3 lines are for material. Apart from that, in the below paragraph, these are the again 3 lines. Okay. Yes. Now it is pretty sure you are going to prepare for whom? For a manufacturer. For a manufacturer. Clear? Now, here sales is given, raw material is given. What to be calculated? Purchases and consumption required, or production and consumption. Sales of finished goods. Then you need to calculate production of finished goods. Similarly, what is the raw material requirement for consuming? So first we will try to finish up A and B. Okay, A and B. Finished goods A and B. We have been given what? We have been given sales budget. So start with the sales, that too only in units. Only in units. So very simple. We never bother about the GP, sales. With that sales, you have to go for the reverse calculation by adding what? Closing stock, subtracting the opening stock. Add closing stock minus opening stock. Then automatically what do you get? It's all about finished goods. No. Finished goods sales means you have to produce it, not purchase it, because you are being the manufacturer. So production budget. This is called production budget. So we get the production here in terms of units. So sales being 3600 for A, 4800 for B. Budgeted material consumption per product, we will use it later on. And budgeted material cost also can be used. These two are for raw material requirement. Raw material requirement. It is anticipated that stock at the beginning of the period will be product A 1020 units, product B being 2400 units. Raw material, we can apply it for the raw material calculations later. The target closing stock expressed in terms of anticipated activity during the budget period are A 15 days. Already we knew that it is 60 days. The detail is for 60 days. Now closing stock should be for A, okay, 15 days sales. 3600 is for 90 days sale, for 15 days sales into 15 by 60. Sorry, 90, no? 60, okay, 15 by 60. Come on, 900 units here. And for B, 20 days sales. So 4,800 is the sales for 60 days. For 20 days, come on, tell me. 1,600. We'll now get the answer easily. 4,500 with the closing stock. Opening stock already we have 1,020. 3,480 units to be produced. For B, 5,000, 6,400 minus 2,400. We are in need of 4,000 units of finished goods to be produced. Okay. Clear? Now we'll go for calculating raw material. Okay, go from the last. First go for the production. And for the production, how many units are you supposed to produce? How many units are you supposed to have for raw material? Now, raw material. What is this? Opening stock given. Closing stock may be 10 days consumption. So we don't have the consumption details as well as purchase detail also. But consumption details can be calculated. How? Raw material consumption. How will you be able to calculate the raw material consumption? So, budgeted material consumption per product being 5. Whatever the units you produce for that A, producing A, every unit requires 5. Okay, product A. 3,480 units were produced. Multiplied with raw material requirement, raw material consumption per unit. 5. 17,400. Similarly, for product B, 4,000 units are supposed to be produced. Per unit requires 3 units of raw material, so 12,000. 29,400 is the raw material consumption. Raw material consumption. Now next we will go for the raw material purchase. For raw material purchase budget, you are not going to sell. Instead of sell, we have what? Production. Okay. Instead of sales, we have the production. So here, raw material consumption is given, so raw material purchase budget to be prepared. Raw material consumption, this is sales budget like, already told you now. Raw material consumption is similar to a sales budget like. So with that, add closing stock minus opening stock. You get raw material purchase. Raw material consumption we just arrived from the earlier working note, 29,400. And opening stock being 4,300. Closing stock being 10 days consumption. 10 by 60. This 29,400 is for the budget period of 60 days. 12 5 days week. So for 60 days raw material consumption 29,400 means we need to maintain 10 days consumption as closing stock. 4,900. 4,900. From that you can very easily calculate the purchase also. Yeah, 29,400 plus 4,900, 34,300. 4,300 is subtracted, so raw material purchase being 30,000 rupees. Price per unit being 12 rupees. So 3,60,000 rupees you need to spend for purchasing the raw material. This is unit, this is rupees. Okay, in rupees it is a financial term, in units means it's only physical term, right? So this illustration comprises the calculation of production budget, raw material purchase budget and all. Raw material purchase budget and all. Now, we'll move on to the next one. What's that? Labor. Labor. I'll start with this one. Standard labor hour per product requirement, and also this particular line. I'll take this from here. Production detail. Production detail. Yes, tell me. This is for A, this is for B. Standard hours allowed per product being 5 and 4. Okay. Now, overtime premium payable being 50% extra. Whatever the regular payment you pay to the employees, probably budgeted wage rate being 8 rupees, hourly rate 8 rupees, overtime premium being 12 rupees. Is that okay? 50% extra. If the employees are asked to work overtime, wage rate being 12 rupees for the overtime. When the overtime premium will be payable? If a worker works for more than 40 hours a week. Okay. How many workers are there? 90 workers are there. If you multiply these two, 90 into 40 hours a week into 12 weeks. Okay. 5-day week, 12 weeks are there. Okay, 90 workers, every week they are working 40 hours. For the budget period, 12 weeks are there. And what is the total value? So, in excess of 43,200. Okay, in excess of. If the employees are worked more than 43,200 hours, for their excess hours, they will be paid 12 rupees. Up to 43,200, no problem. Their salary is only average 8 rupees. Beyond that, they are paid at the rate of rupees 12 per hour. Is that clear? The target productivity ratio or efficiency ratio for the productive hours worked by the direct workers in actually manufacturing product is 80% only. Performance rating, productivity rate only 80%. In addition, the non-productive downtime budgeted 20% of the productive hours. Okay, downtime. Downtime is equal to 20% of productive hours. Productive hours. Okay, that's all. This information is more than enough for preparing the labor budget. Okay, labor budget. Now, come on. How many units are produced? So, what is the time required? 5 and 4. Okay. This one requires 5 hours. This one requires 4 hours. 17,004 hours. 400 hours. 16,000. Hours required. Hours required. What are productive hours? What is the total productive hours required? 43,000. 33,400 productive hours needed. Okay. C. Time allowed being 100. Lost due to the performance rating, only 80 work due to the performance rating and inefficiency. This is called inefficiency 20. From that productive hours, downtime, how much? 20% and that 16 has gone. Only 64 will be the time taken. Okay. Originally, if you are allotting 100 hours, he can work only for 64 hours worth of work. Now, we need 33,400 productive hours means time taken. What about the time allowed? You can do the cross multiplication. Hope you will be now able to understand this. Come on, get me the value. $33,400 into 100 by 64. 52,000. $187. Okay. Okay, they have calculated different way. Okay, I'll work out this way. As per the performance rating formula, what is that? Time allowed by time taken. Time allowed by time taken. Otherwise, time taken in this case is equal to time allowed by performance rating. Time allowed being 33,400 for doing this job. Due to inefficiency, actual time taken being 41,750. Is that okay? This is assumed to be the productive time. On this downtime, being 20%. 8,350. Then time allowed, or this is what about the time allowed, like, okay, this is time allowed, then time taken, actual time taken being with the loss of time, 50,100. Is that okay? Time taken. I told you this way, right? See, 100, 20 is added, 120. This is one approach. As per this approach, this being 41,750, you do the cross multiplication. Another one is, we calculated the other way, where 100 being the total time taken, 20 being the downtime, only 80 is the productive hours. In that approach, what do you get here? 41,750. This one being 41,750. Do the cross multiplication. 41,750. Come on, get me the value. Do the cross multiplication. $52,180. That was the earlier solution. Both are correct only. No need to worry about that. Okay. So it is nothing but 20% profit on cost, 20% profit on sales. Like, okay, that's the approach. Now, in that productive hours, 20% downtime. So productive hours is assumed to be this one. In that 20% is lost. In that 20% is lost. So I calculate 20% on this, and 50,100 is the time taken. Up to 43,200, the payment will be normal, 8 rupees. Beyond that is considered as overtime. For that, around 6,900. For that, the wages being overtime premium wages 12 rupees. Then total wage payable in this case is 43,200 into 8, 3 lakhs 45,600. 6,900 into 12, 82,800. Then overall value being 4 lakhs 28,400. Is that clear? Come on, make a note of it. Shall I move on to the next one? Online students, come on, respond me. I got the response only from one student. What about the others? Make it faster. Yes. One more illustration on production budget. See this one. Now, in production budget, A Limited produces and sells a single product. Sales budget for the calendar year 2011 by quarter is as follows. This will be the sales budget for every quarter. Okay, sales budget. Quarter 1, 2, 3, 4. Sales being 12,000 units, 15,000 units, 16,500, 18,000. The year 2011 is expected to open with an inventory 4,000 units of finished product, closed with an inventory of 6,500 units. Production is customarily scheduled to provide for 2/3 of the current quarter's sales demand plus 1/3 of the following quarter's demand. Now, what about the stock? Opening stock 4,000, closing stock being 6,500. What about the production? Production is equal to customarily scheduled to provide 2/3 of the current quarter's sales demand. 2/3 of current sale. Current sale. Okay. And plus 1/3 of the following quarter. 1/3 of next quarter. Current quarter sales, next quarter sales. Understand? Because they sell ahead for meeting the next year's next quarter's requirement. So the first quarter sales is 12,000 means already they may have stock. How many units they may have to stock? 4,000 units. 1/3. The next quarter's estimated sales based on that 1/3 may be kept in the year beginning itself. So here, out of 12,000, 2/3 is produced in the same quarter, plus 1/3 of the next quarter units produced. 15,000 into 1/3 being 5,000. So 5,000 plus 8,000, 13,000 units produced. Here, 2/3 of the current quarter, 10,000 plus 1/3 of the next quarter, 16,500. So 10 plus 5,500, 15,500. And 2/3 of the current quarter, 16,500. 1/3 of the next quarter, 18,000. Then this value being 17,000. And here 2/3 of the current quarter and plus 1/3 of the next quarter. So this being, what about the 1/3 of the next quarter? The next quarter's requirement produced in this period remains closing stock for the period. What is the closing stock for this period? 6,500. And before that, 0th quarter, what could be the stock? Next quarter, means first quarter sales, in that 1/3 may be there, 4,000. That's how it is given here. This 4,000 being the opening stock, 6,500 being the closing stock. And 2/3, 12,000 plus 6,500, 18,500 will be the production. Clear? We got this information. Now, the standard cost detail for 1 unit of the product is as follows. What are the things are to be prepared? Prepare production budget for 2011 by quarters, showing the number of units to be produced and the total cost of direct material, direct labor, variable overheads and fixed cost. So you have to find out the production for every quarter. Not only that, you have to find out the direct cost, direct material, direct labor, variable overhead and fixed cost for every quarter based on your production. What are the things you have to find out? Okay. So we have to go for direct material. Direct material being 10 pounds required, per pound cost being 50 paise, then total being 5 rupees. The production in the very first quarter being 13,000 into 5, 65,000, 15,500 into 5, 77,500, then 17 into 5, 85,000, 18,500 into 5, 92,500, then overall direct material cost being 3,40,000. Overall production being how many units produced in that period? 64,000 units produced. Then we'll go for direct labor. 1 hour 30 minutes required, per hour being 4, so 6 rupees needed. 1.5 into 4 rupees, 6 rupees required per unit. For 13,000 units production, 78,000. For 15,500, 93,000. For 17, 1,02,000. For 18,500, 1,11,000. 1,11,000. Get me the total here. 3,84,000. 3 lakhs. This is 93, 1 lakh 2, 1 lakh 11,000. Okay. Okay. Now we'll get. Okay. Then when it's all about variable overheads, variable overhead 1.5 hours per hour 1 rupee. Then variable overhead will be calculated at the rate of rupees 1.5 per unit. 13,000 into 1.5, 19,500. This will be 23,250, 25,500, 27,750. Total value being 96,000. Fixed overhead 1.5 hours required per unit 2 rupees, otherwise 3 rupees. 1.5 into 2 rupees for per unit it is 3 rupees. Whenever fixed overhead is given per unit will be applicable only for the budgeted production of 90,000 direct labor hours. So 90,000 into per hour 2 rupees, 1,80,000 rupees will be the overall fixed cost. For the 4 quarter, then per quarter being 45,000, fixed overhead being 90,000 is the capacity per hour 2 rupees for the entire period. For every quarter, you divide that by 4, so the value being 45,000 per quarter. So the overall value here being 1,80,000 rupees. Shall I move on to the next one? If the budgeted selling price per unit is 17, what would be the budgeted profit for the year as a whole? For the entire year. Now, sales, how many units? 64,000 units. Sales price being at 17. Come on, tell me the total sales value. Huh? 10,88,000 minus direct material 3,20,000, direct labor 3,84,000, variable overhead 96,000. What is the total variable cost? 8 lakhs. Now sales per unit being 17 rupees. Variable cost per unit being 8 lakhs divided by 64,000. 8 lakhs divided by 64,000. 12.5. Okay. Then what about the contribution? 2,88,000. Otherwise 4.5. Fixed cost being 1,80,000 rupees. 1,08,000 is the profit here. Now I need to stand corrected. What is the sales here? Sales being 61,500 only, right? You have to calculate for 61,500. Otherwise, I can calculate per unit basis directly. Okay. For 61,500, what is the sales? Total sales? You directly calculate the contribution. 4.5 into 61,500. Okay. So sales is different, production is different, right? How many units were produced? 64, but sold is only 61,500. So you have to recognize the profit only to this extent. Fixed cost 1,80,000 is subtracted, then your profit in this case be 96,750. Now, see, budgeted selling price is okay. What would be the budgeted profit for the year as a whole? Whole means you have to consider only the sales. In which quarter of the year is the company expected to break even? In which quarter it gets break even? Break even point is equivalent to fixed cost divided by contribution per unit. Fixed cost 1,80,000 rupees, contribution per unit being 4.5, 40,000 units. In which quarter? Quarter 1, your cumulative sales being cumulative sales. Quarter 1, you sold 12,000 units, no break even. Second quarter, another 15, so 27,000 units sold, no break even. Third, again you have to add 16,500 with that, 43,500. So here you cross your break even, so you break even by the third year. Okay, by third quarter, sorry. By third quarter you can break. Okay. So you reach by third quarter. Clear? So last two more illustration is all about cash budget. We'll finish up that just like that. So cash budget is nothing but cash requirement prediction. Prepare that as a normal cash book, receipts and payment. That's all. There is no any complications. We'll start with question number 7. Okay. Here is a balance sheet, and the company is developing a system of forward planning, and on 1/10/2019 it supplies the following information. There is cash sales and credit sales, purchases. Okay, in case of cash sales, you get the money immediately. In case of credit sales, you will get the money only after the credit period, subject to bad debt loss also. Is that okay? So prepare cash budget for the months October, November, December. Okay. So for what are the month you are going to prepare? October, November and December. How it should be? Opening balance, add receipts minus payments. You get the closing balance, that becomes the opening balance for the next period. That's all. So usually you prepare this way: opening balance and closing balance, receipts and payment. You now put this in a vertical format. First, opening balance and receipts minus payment, you'll get the closing balance. That's all. But it is not actual receipts and payments based on the prediction what happens the next period. Clear? Now, from this information, what you will get collected immediately? Cash sales collection will be available then and there. So we'll put the value here. Cash sales, receipt side. Value being 5,000, 6,000, 8,000 rupees. All trade debtors are allowed 1 month's credit and expected to settle promptly. There is no bad debt. We'll get the amount collected promptly. All trade creditors are paid in the month following the delivery. Creditors will be collected only 1 month after. So both will have 1 month credit. So then what happens here? Collection from debtors. When will you get? September month sales collected in October, and October month sales collected in November, and November month sales collected in December. We have to prepare for these 3 months, and you don't get this money collected by December 8. September month sales 15,000 collected in October, and November 18 and December 20. Similarly, in payments, September month sales collection means purchases will be paid later on. So payment to creditors 1 month after. So 40, 23, 27. So you have posted all this value. There is no any problem here. And October, these are the 3 more adjustments. On 1st October, all equipments were replaced at a cost of ₹30. 14,000 was allowed in exchange for the old equipment, and net payment ₹16,000. So, equipment replaced. So, you're supposed to pay 16,000 in October. Though the new asset purchased worth 30, but we offered old assets worth ₹14, so we have to pay only 16. And proposed dividend paid in December. What is the proposed dividend? Go and see the balance sheet. In balance sheet, in liability side, we have the proposed dividend. This 15,000 is paid in December. The following expenses will be paid: wages 3,000 per month. Administration expenses 1,500 per month will be payable regularly. Regular expenses every month, the payment will be done for this. In case of rent, 3,600 for the year up to 30th September to be paid in October. Single shot rent 3,600 is paid in October itself. Okay. So in case of rent, in October, how much we are paying? 3,600. For the wages and admin, both put together 4,500 payable every month. Regular expenses. Okay. What about the opening balance? Go and see the balance sheet. You will find the balance here. So that 35,000 is the opening balance. That's all. You add up the opening balance with the receipts, 55,000. Total of payments being 6,400. If you subtract the payment 6,400 from 55,000, your closing balance being 9,100 negative. Overdrawn becomes opening for the next period. Overdrawn means you're running short of cash by the time. You have to be double cautious to make the fund arranged for October month for the shortage. Here 14,900. Payments being 27,500 and closing balance 12,600 negative. 12,600 negative in the next period beginning, and this ultimate value being 15,400. Ultimate total payment for the last month, December, being 46,500. You are running short of cash in the third month, 31,100 rupees. So you have to plan for the cash arrangements. That's what about the use of budget. Action planning you have to do for the budgets. Shall I move to the next illustration? The last one. So with that, entire budgeting is over. Tomorrow we'll start with the ABC costing only for the CA group 2 as well as CMA group 2. Okay, not for the CMA group 1. Okay. We'll go for the question number 8. It's very simple illustration. We'll finish up just like that. I think I don't want to solve this illustration. I'm explaining this only one concept. Rest of the things are very simple. So I'll finish up that. I'm not going to solve this illustration completely. It's copying like capital budget. It's a cash budget. Yes. Now, in this illustration, it's very simple because cash sales, collection from debtors, cash purchases. These two are receipts, cash purchases, payment to creditors, payment to expenses directly given. Okay. So it's very simple that you are going to post all these 5 items easily. Okay. These 5 items, we don't have any confusions. Cash sales, collection from debtors, cash purchases, payment to creditors, and payment to expenses. Okay. We start with what? Cash balance 10,000. That too, that is the minimum cash balance. That is the minimum cash balance. So we started. For April month, we started with 10,000 rupees. With that, other cash receipts added, cash payment subtracted, you will get the balance here. But while getting the balance, receipts 34,000, payments 32,000, balance being 32,000, 2,000 rupees. But this 10,000 rupees, what you have here, you know, that is the minimum cash balance you need to maintain. Minimum cash balance you need to maintain. Any shortfall in the minimum cash balance is to be met by bank borrowings in the multiple of 5,000 at the rate of 12% per annum interest. So loan borrowed 5,000 size, lot size. Applicable interest rate in this case being 1% per month. 12% per annum means 1% per month. Or if you have the sale marketable securities, you can sell. But in case of marketable security, the lot size is 10,000 rupees. Lot size is 10,000 rupees. And bank interest on monthly basis is payable on the first day of the subsequent month. And the bank rate of interest is payable for a minimum period of 1 month. 1% per month. Even though loan borrowed only for a day, yet you have to pay the interest at the rate of 1% for the day. Is that okay? For the day. Any surplus cash is to be used to repay the borrowings in the multiple of 5,000. If you have the surplus, first give the priority to settle the liability. Okay. If you want to repay the loan, the repayment will be in the lot of 5,000 rupees. Still, you don't have the loan, then you can purchase the marketable securities in the multiple of 10,000, ignoring interest on securities. In case of loan, of course, you have to pay the interest to the rate of 1%. In the case of investment, you don't have any interest revenue. So this is the main point to be noted. So in the very first instant, you have how much? 2,000 rupees only. Receipts minus payment, you have 2,000 only. Shortage. You don't have the securities in the first month. Then you have to go for borrowing. How much you have to borrow? To maintain the minimum requirement of 10,000 rupees. you need 8,000 rupees. But if you want to go for borrowing, you have to borrow 5,000 in every lot. So you have to borrow 5,000 rupees worth loan. So 10,000 borrowing is there. 10,000 borrowing is there. Is that clear? With that borrowings, the closing balance 12,000 becomes the opening balance for the next period. In that period, again, you add the receipts total 56,000, subtract the payments, you will get 41,000 and surplus being 15,000 rupees. But earlier period, we have the loan, right? How much loan is there? 10,000 rupees. For the next month, you have to pay 1% interest on that for 12,000 rupees. So 10,000 rupees, 1% interest being 100 rupees is payable. 100 rupees interest is paid and 15,000 minus 100, you have 4,900 effectively. 4,900 is above than the minimum requirement. Above than the minimum requirement. What is the minimum requirement? 10,000 rupees. How much you have now? 4,900. No problem. You have the excess. If you have the excess, you have the two choices. Either you can repay the borrowings or you can buy the investment. So if you go for repaying the borrowings, you already have the borrowings rupees 10,000 rupees. If you want to go for borrowing, repayment of the borrowing, the lot size is 5,000 rupees. Beyond 10,000, you have only 4,900, not sufficient enough for repaying the limit. So no repayment, no purchasing the securities, the closing balance 4,900. This 4,900 becomes the opening for the next period. With that, add the receipts and subtract the payments, the ultimate value being 1,900 rupees. 1,900 rupees you have, but of course you have the interest. So interest 100 rupees is payable. So after paying the 100 rupees interest, you have 19,000 rupees. Minimum balance requirement being 10,000 rupees. Surplus money is how much you have? 9,000 rupees. If you have the surplus, verify whether you have the loan. Yes, of course you have the loan. How much the loan you have now? 5,000 plus 5,000, 10,000 is there. You can repay the loan out of the surplus, but surplus is only 9,000 to 5,000 borrowings is there. So you can finish up one borrowings of 5,000 rupees. So repayment of borrowings happens here. So from this 9,000 rupees, you can repay another 5,000 rupees. Then automatically your closing balance being minimum balance plus another 4,000, 14,000 will be the balance. 14,000 becomes the opening for the next period. With that, add the receipts and payment. You now have 27,050. Now, how many borrowings still you have? One borrowings of 5,000 rupees. For that, interest is payable. For this month, means July, you have 27,050. Out of that, interest 50 rupees has gone and balance 27,000 is there. So minimum requirement being 10,000. Minimum requirement 10,000 you have to maintain, and you have 17,000 surplus. If you have 17,000 surplus, first work goes for settlement of the borrowings. Do we have the borrowings? Yes, we have the borrowings. How many borrowings? Only one borrowings of 5,000 rupees. So you can repay the borrowings. Apart from that, still you have how much? 12,000 rupees you have. After the repayment of borrowing, if you have 12,000 rupees, the next choice goes for purchasing the securities. If you want to purchase the security, you have to purchase in a lot size of 10,000. So I purchase the security for 10,000. So from 2750, interest 50 paid and repayment of loan 5,000 is paid, and purchases securities 10,000 is also subtracted, and 12,000 is the closing balance. So 12 becomes the opening for the next period. And in this year, we have only 5,000 rupees. You add the receipts and subtract the payments, you have the balance only 5,000 rupees, which is less than the minimum balance of 10,000 rupees. But you don't have any loans, so no interest payment. Minimum balance should not go below 10,000 rupees. If it is so, go and check whether do you have securities. Yes, of course, we have the securities. You can now sell the securities and realize that money. Sale of securities, you can add this one. So with that 5,000, after amount collected by selling, you get 15,000 rupees. That 15,000 becomes the opening balance for the next period. And year end, you have the surplus 19,000 rupees. If you have surplus 19,000 rupees, beyond 10,000, you have 9,000 rupees. First choice goes for loan repayment, but we don't have the loan. Okay, if you don't have the loan, then you can go for purchasing the securities. Can we purchase the securities? Of course, we cannot purchase the securities. If we want to purchase the securities, the lot size being 10,000 rupees, we don't have that. So naturally, that 19,000 remains as it is as the closing balance the year end. Clear? So with that, the budgeting is completely over. But anyhow, most of the students get stuck with the budgeting, because especially this purchase budget and labor budget and all, no, you have to guess. Not, there is no pre-formatted, right? In case of flexible budget, there is a format, no problem. But in case of purchases and sales production, I have given a small format, but logically you have to think a lot. Sometimes find out the sales budget for north zone of India, south zone of India, and west zone of India, and east zone of India. That's how you can calculate the sales budget for every zone. Okay, that way also some confusions may be created. So do some practice so that budgeting can be comfortably thorough with your